I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org.
Thank you for joining us today to explore FCLTCompass, the first measure of investment time horizons across the global capital markets. Our new dashboard links investment behavior to quantitative data reported in years and dollars, providing clear insight into current market dynamics and framing the conversation around actionable steps to strengthen the future of sustainable finance. This project is a culmination of many years of work for many different organizations, and we're thrilled to share it with you today. We will share the theory behind FCLTCompass, discuss the findings from our first data set, and then before we dig into the details, it's important to understand why this project is necessary in the first place. People around the world are saving money to meet important personal goals, such as paying for an education, funding a comfortable retirement, or buying a home. Effective capital markets allocate these long-term savings to businesses to fuel innovation and fund business growth, which in turn results in savings and job growth. In the wake of the 2008-2009 global financial crisis, business leaders knew something had to change in order to safeguard this process. The Focusing Capital Long-Term Initiative and FCLT Global's founding are a direct result of that recognition. Despite significant evidence that shows that taking a long-term approach to investment decision-making delivers superior value over time, both managers and investors struggle to balance immediate financial pressures against long-term objectives many years into the future. In part, this struggle is because long-term is more of a future-oriented state of mind than an actual time horizon. It's too easy for companies and investors to look for the short-term pop, rather than investing the time, money, and effort necessary to build lasting performance and superior results. Our work is focused on pinpointing the key levers that can elevate long-term performance and counteract these short-term tendencies we all have. So we're often asked questions like, how long is the average investment time horizon? How have those time horizons shifted and where are they headed? And how much money really is focused on the long term? FCLTCompass provides answers to these questions by anchoring the abstract concept of long-term investing to quantitative data reported in years and US dollars. This frames the conversation in a more actionable light. The data reveal a number of important conclusions. First, and most critically, a significant intention allocation gap exists between the intended investment horizons of savers and the actual timeframes of their investments. Similarly, companies have long-term intentions for their investments, but there's a gap compared with their sources of capital, which carry much shorter-term investment horizons. Next, the shift to indexed equity has reshaped global investment horizons by contributing to an overall increase in average holding periods. Asset gathering by index products is now a global phenomenon, contributing to the rise in equity investment horizons since the global financial crisis. Third, the decade-plus long low interest rate environment has caused investment horizons for fixed income to shorten and has inspired yield chasing, with riskier asset classes seeing accelerated asset gathering while fixed income allocations have slowed. And finally, our study shows varying regional trends based on investment behavior in different countries. Of particular note, asset growth in China has largely been driven by the ascendance of the middle class, but its savers have among the shortest term allocations in the world, pushing the global average savers investment horizon lower and affecting investment trends in the region. We're excited to share more about this groundbreaking project with you. Our head of research, Ariel Babcock, and other members of our team will now walk you through this and explain the ins and outs of the project and discuss more of its important findings.
Thank you, Sarah. Hi, I'm Ariel Babcock, Managing Director and Head of Research for FCLT Global. Thanks for joining us to learn more about our Compass project. As Sarah mentioned, this is the culmination of many years of work on the part of many people across many organizations. Our members were an integral part of our research process. I'd like to especially thank our friends at CPP Investments, EY, GIC, Kempen Capital Management, MSCI, and NASDAQ, all of whom dedicated time and expert advice that far surpassed the norm and did it in a year that was far from the norm. Without sound numbers, we would not have been able to build this project. Our sincere thanks go to the team at Core Data for making these findings possible. At its most basic level, FCLTCompass is a map that traces funds as they flow through capital markets from savers to their ultimate destination. We do this by first measuring savers' capital and tracking how it's allocated across a wide array of available asset classes. A saver can be one individual or several in the case of a household, or a saver can be an institution like a pension fund, insurer, sovereign wealth fund, endowment, or foundation. Savers have long-term goals like saving for retirement, providing for the next generation, or financing a particular purpose or mission, and they allocate their capital in pursuit of those long-term goals. After mapping savers' capital across asset classes, we then look into corporate sources of capital and at how capital is deployed by public companies to support business growth and long-term strategy. Tracking these asset flows around the world provides a snapshot of how capital is allocated in a given year and how those allocations have shifted over time, creating the groundwork for the FCLTCompass. Our initial study focuses on the post-financial crisis period from 2009 to 2018. The plan is to grow this data set over time by updating it annually so we can see what trends emerge over longer periods. It's clear from these snapshots of asset flows that household savings are the primary source of wealth, providing the raw fuel to finance capital investments and economic growth worldwide. Although households control most of the wealth, their distributed decision-making authority dilutes their influence on capital markets. That diluted influence is due not only to their widely dispersed number, but also reflects their asset allocation choices. By favoring cash and real estate, household savings have a blunted influence on major equity and fixed income markets. Even so, households are the swing voters, and small shifts in the asset allocation of households in a particular country carry significant ramifications for investment horizons, asset class valuations, and even market volatility at times. The allocation preferences of various types of savers really comes to life with this data. For example, while households generally considered less sophisticated retail investors tend to prefer cash and real estate, pensions have a much lower allocation to these two asset classes and a much greater emphasis on fixed income. But those fixed income heavy allocations traditionally common in pension portfolios stand in stark contrast to the average endowment allocation. With the ability to take on riskier assets due to their less regulated nature, endowments often have allocations that skew heavily into alternatives and emerging asset classes in pursuit of higher returns. All of this data is available in our report published on Monday and can also be found on our interactive dashboard on our website at fcltglobal.org. Using the dashboard will allow you to highlight specific areas of the data that may be relevant to your work, including the asset flows, our regional breakdown, and all the areas of the project we're about to discuss. We can now turn to the crux of the project, time horizons. After mapping the asset flows, we can determine the average time horizon of each segment of the investment value chain. The term investment horizon describes the total length of time an investor expects to hold a security, portfolio, or other asset. In the case of a saver, their intended investment horizon is usually the time frame aligned with the goals attached to the capital. A household saving for retirement in 25 years would have an intended investment horizon aligned with that 25-year goal. In the case of asset classes, the investment horizon is the average holding period of a security or investment instrument. A company's investment horizon often matches the average life of the assets in which they invest. Items that make up a corporate investment portfolio, like patents, machinery, and software, all have average useful lives. By attaching an investment horizon to these various pieces of the investment value chain, we can compare the intended investment horizons of the assets that comprise a company's sources of capital with the actual time horizons of companies' investment allocations. In 2018, savers on average had investment horizons of upwards of 13 years. In many cases, that extends beyond a full business cycle. But the capital markets as currently structured are not meeting the long-term intentions of the saver community. Taken as a whole, the dollar-weighted average investment horizon of asset classes is just 5 years, while the average investment horizon of a public company is a bit longer at 5 years, 8 months. This discrepancy is a core focus of the project. It is a clear example of how capital markets as currently structured are not meeting the needs of everyday savers who are managing their money for long-term goals. This mismatch is different for different types of savers and investment organizations around the world. On balance, savers have intended investment horizons in excess of a decade, but the public companies invested their capital on a blended average basis of 5 years, 8 months in 2018, down from 6 years, 6 months in 2019, a 14% decline over the last decade. And while corporate sources of capital actually lengthen their horizons by almost 40% over the same period, there's still a significant gap between the investment horizon of the capital allocation decisions made by corporate leadership and their sources of financing. That gap may be putting undue pressure on companies to shorten their own investment horizons and prioritize near-term results. Addressing the disconnect in these investment timeframes will be key to unlocking the real savings potential of capital markets. These two pieces, measuring asset flows and measuring time horizons of the key players along the investment value chain, are the core pieces of the Compass project. From that base, we can deduce a number of other key findings about the state of play in capital markets today. I'll now turn it over to my colleagues, Alan and Victoria, to discuss some of the implications for investors and some high-level thoughts about what we're seeing out of global trends.
Thanks, Ariel. Hello, I'm Alan He, Associate Director of Research here at FCLT Global. One of the key findings of our initial FCLTCompass report spotlights the impact of the global shift to index equity. The large-scale departure from active equity has led to an overall increase in average equity holding periods and therefore increased the average time horizon for investors. As Sarah alluded to earlier, asset gathering by index products has contributed to the rise in equity investment horizons since the 2008 financial crisis. Now, this goes for both mutual funds and ETFs as well. We see that this trend started in the United States, but has now become a global phenomenon. In 2018, investment horizons for index equity products, as indicated by average equity holding periods, was a little under 11.5 years, compared to just 2.5 years for active products, explaining the majority of the increase we see in investment horizon as index products became a more prominent feature in portfolios. While the shift to index equity has driven the bulk of the overall increase, active equity investment horizons have also increased, an encouraging trend that can be linked due to the rise in sustainable investment. During the research for this inaugural report, third-party data showed that the proportion of assets managed in a sustainability lens increased by roughly $8 trillion in just the last 3 years of our study. In fact, we see evidence of the adoption of sustainable investing and the increase in ESG controversies related to improved monitoring and reporting, as well as the decline of carbon dioxide emissions from the power sector in advanced economies. As sustainable investing becomes more widespread, it'll likely lead to a continued rise in average equity investment horizons, largely because the sustainable funds tend to have lower portfolio turnover while having longer average holding periods. We see, however, that the lengthening time horizons in public equities stand in sharp contrast to the trends in the same period for fixed income. Investment horizons for fixed income shortened, and the low interest rate environment inspired yield chasing over the time frame of our study. Riskier asset classes saw accelerated asset gathering, while growth in fixed income allocations slowed. FCLTCompass data also backs up these trends, especially with pension portfolios. During this period and in the years since, interest rates remained low worldwide and growth in fixed income slowed in favor of risky asset classes like real estate, private equity, hedge funds, commodities, and the like. Pensions, indeed, rotated away from fixed income towards these emerging asset classes, a change that adds diversification, but also includes more risk, a wider range of potential outcomes, and an overall decline in average pension investment horizons over this period. Finally, it's important to note that these findings are not unique to any one area of the world. We started with the 10 largest economies by GDP, but over time, we hope to grow our global data set. For now, I'd like to hand it off to my colleague Victoria Tellez to discuss some of the global trends.
Thanks, Alan. I'm Victoria Tellez, Senior Research Associate at FCLT Global. A primary goal of FCLTCompass is to develop a data set that measures regional asset flows and investment horizons on an annual basis, in the same way it measures the movement of capital on a global level. Economies in every region experience cycles and volatility, and savers' financial futures are tied to these shifts. Companies and investors everywhere can be susceptible to the temptation of short-term gains. Likewise, the benefits of long-term financial decisions are not unique to any one country. FCLTCompass references 2018, a relatively calm year in the capital markets, as the base year for the global analysis and begins with the top 10 national economies by GDP. On a worldwide level, the trend that has stood out the most in the data is the changes taking place in Chinese markets. Within the past decade alone, asset growth in China, which includes the special administrative regions of Hong Kong and Macau, has accelerated considerably. This growth has largely been driven by the ascendance of the middle class. Chinese savers' wealth more than tripled from 2009 to 2018. But savers in China have amongst the shortest term allocations in the world. The short-term investment time horizons are driven by higher portfolio allocations to cash and real estate versus other asset classes, a preference that has dominated that market since at least 2009. Several reasons factor into these preferences. First, China has more volatile and less mature equity markets, characteristics which could make the risk-reward profile of equities less attractive for conservative savers. Second, there are less liquid fixed income markets, and these securities carry a riskier credit profile. Third, alternative and emergent asset classes are still in early phases of maturity in China. And finally, there is still limited access to investment products, especially in rural areas, and there are considerable restrictions on the flow of investments. These factors, as well as others, likely contribute to Chinese savers favoring the relatively more stable investment portfolio of cash and real estate. As markets mature, investment behaviors in the region will likely shift over time. Eventually, some asset class rotation will be necessary to ensure that households can achieve their long-term savings goals. Given the magnitude of wealth in China, this shift will have significant implications for investment time horizons worldwide. Similar investment data was included in the FCLTCompass for Brazil, Canada, France, Germany, Italy, India, Japan, the US, and the UK. That information can be found on the interactive dashboard of our website. I should note that there are still gaps in the data. Some gaps are due to a lack of disclosure, where others are due to a lack of a particular type of saver in a certain area. For example, the lack of endowment numbers in France is due to the fact that the endowment legal structure is not common in that country. Similarly, while sovereign wealth fund data is sometimes difficult to uncover, in this case, the many blank fields result from the fact that of the 10 countries included in our initial study, only China has sovereign wealth funds. We also acknowledge that there are significant differences in the characteristics of government-issued versus corporate-issued debt. And as more detail becomes available, separating fixed income assets by issuer type would lend a helpful perspective. I'd like to turn back over to Ariel to discuss the public company trends.
Thanks, Alan and Victoria. Several themes within our data directly contribute to the investment intention allocation gaps at public companies. These could be a response to the global financial crisis or the result of much longer-term trends, but the combination has resulted in a compression of corporate investment time horizons worldwide. First, the shift towards fixed asset light business models naturally contributes to declining investment time horizons by changing the composition and average useful life of assets in the company's portfolio. As companies have shifted spending from fixed investments like CapEx towards things like acquisitions, R&D, dividends, and buybacks, the profile of the average company's investment portfolio has evolved. That evolution puts downward pressure on corporate investment horizons. Similarly, the growing importance of technology and intangible assets may accelerate this evolution in the business model. Over the 10-year period, as a percentage of total public company spending, we saw CapEx decline by over 6%, acquisitions increase by almost 2%, dividends increase by 1.5%, and buybacks increase by upwards of 4.5%. Despite that shift, companies have more debt outstanding than ever before, with issuance from the MSCI All Country World Index increasing by 50% over the study period. The fact that debt outstanding has increased in a period of extremely low interest rates is not particularly surprising, but alongside a preference for returning capital to shareholders, excess leverage could pose risks to corporate resilience. While it's not measured as part of this project, we also took note of the fact that the decline in corporate investment horizons is aligned with the decline in CEO and CFO tenure. Median CFO tenure fell from 5 years in 2009 to just 4 years in 2018, and CEO tenure fell by an average of 3 months in that same period. Whether this decline in executive tenure is a symptom or a cause of the broader decline in corporate investment horizons remains an open question. But expecting CEOs to make long-term decisions without being present to see the benefits of them requires a lot of oversight.
Ariel, thank you very much for that. And thank you to our other speakers. We now have just a few minutes for some questions that we have received from our audience in the chat box. And if you'd like to put more questions in there and we don't have time to answer them all, we're happy to follow up offline. So one of the first questions we got was, were there any findings that surprised us in the research? And maybe I'll give one perspective and ask Ariel to give another. You know, one of the things that this perhaps surprised or maybe reminded us is that when you look at the households who make up the bulk of the savings in the world, they're really concentrated in the 4 big asset classes of cash, real estate, equity, and fixed income. So while as an institutional investor, there's a lot of discussion about alternative assets, private equity, and so on, it reminds us that the households typically have their savings tied up in those. And Ariel, we got a question about the real estate that's related to the household. So households obviously live in real estate and also invest in real estate. Do you want to talk just a little bit about how we thought about real estate as it relates to the households?
Sure, thanks, Sarah, and thanks for that question from the audience. So
As you can see from our data, most households have the bulk of their wealth tied up in either cash or real estate. And if you take a step back and think about why that is, it's because for many people in the saver community, their primary residence represents a significant portion of their total household wealth. We debated internally about whether it was appropriate to include a primary home in a person's picture of wealth or household savings picture, and decided ultimately, that it really is a big part of the financial future for a household. So their primary homes are in there. And when you think about the impact that has on an investment time horizon, those homes are usually held for quite some time. So that does help lengthen the investment horizons of the households. If you take a look at the data for real estate, just kind of expanding out on that question a bit, for other members of the saver community, say for a pension or an endowment, the sovereign wealth fund, their real estate portfolio clearly looks very different. It's a combination of commercial and residential real estate. And we took a blended average for a holding period on those pieces. But hopefully that adds a bit of color to what we were thinking on that front.
Great. So please do send any other questions that you would like us to answer. I think the last thing I'll add on that real estate point is that we do know, looking at long time series, that those are important, that home ownership is important also for wealth equity over time. And so we do think it's an important part of the whole picture. So I guess we'll wrap up and say thank you for joining us today. It's an exciting time for us at FCLT Global to be premiering this work after so much time spent building this dashboard with Ariel's leadership. It was a goal of ours from the beginning in 2016 to find a way to measure the state of long-termism. And this goal has been to develop a tool to improve investment behaviors and decision-making in a way that benefits everyone who has a stake in this investment value chain. So we really hope that this first annual edition of FCLT Compass offers an opportunity to think critically about the structure of capital markets today. We offer this tool to highlight gaps and opportunities in those markets in the hope that we can navigate our way towards a rewiring of capital markets for the benefit of savers and in support of economic growth, which of course is the goal of FCLT Global. And as always, we welcome your comments and suggestions on our research. We will continue to develop the FCLT Compass over the years to come, and we look forward to continuing this important conversation. Thanks for listening to today's episode of Going Long with FCLT Global. Be sure to hit subscribe to get new episodes every other Monday. To learn more, visit our website at fcltglobal.org.